Okay, let's unpack this. Welcome back, everyone, to The Deep Dive. This is where we take those dense corporate reports, the analyst notes, all that raw data, and try to, make sense of it all for you.
And today, yeah, we're circling back to a company we've been tracking really closely. That's AXIS REIT, or AXREIT, right? We're looking at their latest update, the Q3 2025 financials.
Right, and if you were with us for the Q2 deep dive, you'll remember that sort of split personality we saw. On one hand, the actual properties.
Yeah.
Doing great, strong income growth, really solid operations.
But the other side, the financial structure,
Yeah.
that was flashing some serious warning signs. We talked about cash reserves dropping sharply and this really worrying shift towards relying heavily on short-term debt.
Exactly, the Jekyll and Hyde thing. So the mission today is pretty clear. We need to dig into these Q3 numbers and the quarterly stuff and the full 9 months and answer that key question. Is the operational strength, the actual logistics properties doing well, is that finally enough to balance out those big financial structure risks we saw building?
Or did Q3 just confirm that those deeper structural problems are still very much there?
So let's start with the headlines then. And operationally, you have to say they look impressive.
Undeniably strong, yeah. If you compare Q3 this year to Q3 last year, Q3 2024, the growth is, well, it's pretty spectacular. Net profit jumped up to RM52.12 million.
Wow, okay. From what?
From RM37.77 million in Q3 2024. So a really significant leap.
Okay, and revenue.
Revenue also grew strongly. Hit RM92.77 million. That's up from about RM80.27 million same time last year.
And the key metric for REIT, right? The net property income, NPI. How did that look?
That's the engine, exactly. And it jumped 15.7% year over year, reached RM80.23 million compared to RM69.35 million back in Q3 2024.
15.7%. That's not just ticking up. That's like powerful growth. Shows real demand for their spaces.
Absolutely. It's fundamental operational strength.
Yeah.
#TechFI. Dissecting the financial performance, Q3 2025 and 9M 2025. And if you broaden the view, look at the whole 9 months of 2025. That momentum holds. It wasn't just a fluke quarter.
Okay, so the 9M numbers.
Cumulative revenue for the 9 months grew 17.5% compared to the same period in 2024. That's RM272.89 million versus RM232.34 million.
17.5% revenue growth over 9 months.
Yeah.
Solid.
And profit.
Net profit for the 9 months also followed suit, rose to RM148.20 million.
And the MPI over 9 months, did that hold up too?
It did, yeah. Grew 18.6% cumulatively, reached RM237.57 million for 9M 2025.
Okay, 18.6% NPI growth over 9 months. When you see numbers like that, close to 20% in industrial real estate,
Well,
you got to ask, what's really driving it? That kind of growth doesn't just happen.
no, it doesn't. And the manager actually breaks it down pretty clearly. They point to 3 main drivers. And it's a really nice mix, actually. Some from acquisitions, that's the external accretive growth, and some from just running their existing properties really well, the organic strength.
All right, let's take the external first, the acquisitions. Right, so rental contributions from the properties they bought recently. This is basically proof that their acquisition strategy is working. They buy something, plug it in, and boom, it adds to the NPI pretty quickly.
Makes sense. What's the second driver?
Second one points to really good execution. They managed to get full occupancy at their AXIS Mega Distribution Center Phase 2.
Ah, the big one. When was that fully leased?
They hit full occupancy back in January 2025. Remember, that phase was only completed in Q1 2024. So getting it fully tenanted that quickly shows they're, very effective at leasing in a hot market.
Definitely. High occupancy is key in logistics.
Mhm.
And the third factor, you mentioned organic strength.
Yeah, and this one is maybe the most reassuring for the long term. It's positive rental reversions across the existing portfolio.
Okay, rental reversions. Remind us what that means exactly.
It just means when an existing tenant's lease comes up for renewal or maybe expires and they get a new tenant, they're successfully negotiating a higher rent than before.
Got it. So basically, they have pricing power. Their existing properties are in demand, allowing them to charge more.
Precisely. It confirms the quality and desirability of their locations. That's the kind of organic strength investors love to see.
Okay, so NPI is booming. How does that translate into what unit holders actually get? The distributable income.
Well, given AXREIT's policy, they aim to distribute about 99% of their realized income. That strong NPI growth flows pretty directly through to the distributions.
And the number for Q3 distributable income, I saw it look huge.
It was RM58.93 million for Q3 2025.
58.9 million. How does that compare?
Compared to Q3 last year, it's up a massive 41.8%. Last year was RM41.57 million.
Whoa, 42% increase in distributable income year on year. That sounds amazing. But hang on, how much of that is repeatable core rental income versus maybe something else boosting it, like a one-off?
That's exactly the right question to ask. Because while the MPI growth is real and strong, part of that distributable income jump was helped by something non-recurring. We need to look at realized income versus unrealized. The realized net income for the 9 months was that RM148.2 million figure. But the key is, the income available for distribution included gains from selling an asset. We'll get into the specifics of that shortly.
Okay. So realized income is what they can actually pay out. Unrealized stuff like property revaluations or derivative movements, that doesn't hit the distribution.
Exactly. Those affect the balance sheet, the comprehensive income, but not the cash they have to distribute right now.
Got it. So with numbers this strong, operationally at least, what's the management saying about the future? Feeling confident?
Very confident, yes. Their official outlook is optimistic. They explicitly state they expect to maintain this level of performance through Q4 and for the full year 2025. And they anchor that confidence on basically those two pillars: the existing portfolio continuing to perform well and their ongoing active acquisition strategy, #tag2, operational efficiency, and portfolio status.
Okay, let's shift gears a bit from the financials to the actual physical assets. The properties themselves, how many do they have now?
As of the end of September 2025, the portfolio stands at 68 properties.
68. Wasn't it 69 before?
It was, yeah. That slight change reflects that active management piece we mentioned. They completed the disposal of one property called the Annex back in Q2 2025.
Right, so selling off assets that maybe don't fit the core strategy anymore.
Exactly. It's about optimizing the portfolio, maybe consolidating, focusing capital on the highest yielding assets, usually the bigger logistics and industrial ones.
Makes sense. Now, keeping 68 high-spec industrial buildings running smoothly, that takes ongoing investment, right? Maintenance, capital expenditure, CapEx. Are they spending enough to keep the assets up to scratch, or are they maybe cutting corners there to boost short-term numbers? What did the 9M 2025 data show on CapEx?
Good question. The cumulative data for the first 9 months actually shows pretty strong commitment. Total major maintenance and CapEx came in at RM19.025 million.
19 million. Okay, can we break that down? Where's that money going?
We can get some detail from the first half numbers. For the first 6 months of 2025, they spent about RM13 million of that total, and specifically RM6.4 million went into property enhancements, so physical upgrades to the buildings.
Which presumably helps them get those positive rental reversions we talked about.
Precisely. And another significant chunk, RM6.6 million, was spent on extending a leasehold period for one of the properties.
Extending a leasehold. That sounds less exciting than upgrades, but important.
Critically important, actually. It might not sound glamorous, but spending money to extend the ground lease on a property prevents future problems. As a leasehold gets shorter, the asset value can start to decline. That's impairment risk. Extending it provides long-term certainty, preserves the asset value, and ensures they can keep collecting rent for decades longer. It's prudent capital management.
Right, it protects the long-term income stream. And you mentioned property income was up about 3% just quarter on quarter. Those enhancements likely feed into that.
Absolutely. Now, on the flip side of spending, property expenses. I noticed they rose quite a bit quarter on quarter, like 9.3%. The report mentioned higher one-off repair costs. Given the cash situation we'll discuss later, that raises a flag. Do we know what those repairs were? Is there a risk of that happening again soon?
The report didn't detail the specific repair, unfortunately. But, with a large portfolio like this, occasionally you'll get hit with a big, maybe unexpected repair bill. Could be a roof, could be structural, something a tenant contract might require fixing urgently. Management calling it one-off suggests they don't expect it to repeat immediately in Q4.
Yeah.
But, yeah, it does eat into the MPI.
And it highlights the need for that ongoing CapEx. As the portfolio ages, maintenance needs might just naturally trend upwards over time.
Okay, now, this is where it gets really interesting, I think. The growth strategy. Despite the financial pressures we've hinted at, they're pushing ahead with more acquisitions.
They are, actively. They've announced 2 new proposed acquisitions. Together, they're worth about RM130 million.
Okay, RM130 million in new deals. Let's break those down. What are they buying?
Right, because they're quite different. The first one is a warehouse in Telukgong that's valued at RM80 million. And this one looks like a very stable, straightforward deal. It's already fully leased
At least two.
to a company called Tucson Logistics, and it's expected to give an initial yield of 6.4%. Solid.
6.4% yield, fully leased. Sounds like a safe bet. What's the timeline on that one?
That one's a bit longer term. They're targeting completion in Q4 2026, so it's adding stable, predictable income, but not immediately.
Okay. And the second acquisition?
The second one is an industrial property in Bandar Sultan Suleiman. This one's valued at RM50 million.
And the risk profile here, you said it was different.
Significantly different, yeah. The timeline is much shorter. They're targeting completion in Q1 2026, so quite soon.
Yeah.
But the key detail is this property is currently vacant, unoccupied.
Okay, that is a big difference. One guarantees income from day one, the other needs tenants found quickly.
Exactly. It introduces leasing risk. Now, analysts seem pretty confident AXREIT can find a tenant, given their track record in logistics. But still, if it takes time to lease up, that delays the income, even with the faster completion date.
Right, execution risk makes sense.
Mm-hmm.
Are there any other acquisitions still in the works from before?
Yes. We need to remember the one that's been pending for a while. That storage yard in Kawasan, Perindustrian, Bukit Raja, that was valued at RM38.8 million, mentioned back in Q1 reports, still pending completion according to this latest update.
Okay, so add that on. The total active pipeline is closer to, what, RM159 million then?
Roughly, yeah. Around RM168.8 million in various stages.
And how does that RM130 million in new deals compare to their overall targets for the year?
Well, some analysts had estimated AXREIT might be aiming for around RM430 million in acquisitions for the full year FY25. So this RM130 million represents about 30% of that potential target. Still ambitious, especially considering, well, the debt picture.
We'll get there. What's the expected impact of these acquisitions, assuming they go through and get leased up?
Analyst forecasts suggest that once this RM130 million pipeline is fully contributing, say by FY27, it could lift core net profits by about 1%.
1%. That sounds small.
It might sound modest, but in the REIT world, growth is often incremental. You build it block by block. Every bit of accretion adds up over time, helps stabilize dividend growth. It's about consistent, steady building.
Okay, fair enough. Now let's connect back to that asset sale you mentioned, the annex disposal. That happened in Q2, right?
Correct. Completed in Q2 2025.
And you said the gain from that flowed into the Q3 distribution. How did that work?
Exactly. Selling the annex generated a realized net gain cash in hand, basically of RM8.825 million that was available for distribution. 8.8 million. And because of their 99% distribution policy, that gain went straight into the pot for the Q3 payout.
So it directly boosted the DPU for that quarter. Can we quantify how much?
We can. The reports indicate that 0.14 sen of the total 2.65 sen DPU declared for Q3 came directly from that annex disposal gain.
0.14 sen. Okay, so that's the non-recurring bit.
Yeah.
Investors need to mentally subtract that to see the core operational distribution level.
Precisely. It's important to understand what's sustainable rental income versus a one-off gain from selling something. It highlights why looking at the non-taxable components of a distribution matters. Hashtag IV, capital management, distribution, and liquidity concerns. All right, let's shift focus squarely onto capital management now. Starting with the distribution itself. Q3 2025 DPU was declared at 2.65 sen per unit.
2.65 sen.
Yeah.
That lines up with their policy.
Yes, perfectly. The manager proposed distributing 99% of the realized income available, and this DPU reflects that commitment.
Okay. And we know 0.14 sen of that came from the annex sale, which is non-taxable gain. What about other non-taxable bits?
Yeah, distributions can have different components based on the source of the income. Asset sale gains are often non-taxable, unlike rental income. The exact breakdown beyond the annex gain wasn't specified here, but that's the main non-recurring element highlighted.
Got it. And they also use that reinvestment plan, right? The IDRP.
They do, the Income Distribution Reinvestment Plan. They issued new units under this plan back in Q1 2025.
How does that help them?
Well, it allows unit holders to take their distribution as new units instead of cash. This generated about RM17.25 million in net proceeds for the trust. It's like raising capital internally. And management specifically used that cash to fund property enhancements.
Ah, so it's a loop. Distributions help fund upgrades, which support future income and distributions. Clever.
It can be, yeah. A way to retain capital for investment without solely relying on debt or external equity.
Okay, now for the less rosy part, the bit we flagged last quarter. Liquidity. Cash flow. Despite the great MPI, the big distributable income number, what did the 9-month cash flow statement actually show? Is the cash drain still happening?
Unfortunately, yes. This is the critical structural issue. The Q3 report confirms it loud and clear.
Ugh.
For the 9 months ending September 30, 2025, there was a net decrease in cash and cash equivalents of RM56.106 million.
Oof. 56 million decrease in cash over 9 months. So even with strong operations, they're burning through cash on the balance sheet.
That's the reality. The strong MPI isn't translating into more cash reserves. It means they're relying on external funding or asset sales to cover things like acquisitions, capex, and potentially even distributions if the cash flow timing is tight.
Which puts enormous pressure on the debt situation.
Exactly. It leads us directly to the debt structure vulnerability. This remains, I think, the #1 financial risk here.
And the number that jumps out is the short-term debt. How much is due within the next year now?
As of September 30, 2025, the amount of financing classified as short-term, meaning it needs refinancing within 12 months, was still a massive RM787.684 million.
Nearly RM788 million needing to be rolled over in the near future.
Now, we should add context here. Last quarter, Q2, that number was even higher. It was over $1 billion. RM1.067 billion.
Right. So they have paid some down. How?
Primarily through that big placement exercise they did back in November 2024. They raised about RM445 million specifically to pay down short-term debt. So they did execute on reducing it.
Okay, so credit where it's due for tackling that. But
Yeah.
still, almost RM788 million left. That's still a huge refinancing hurdle right in front of them.
It absolutely is. And it represents that shift we noted before. At the end of 2024, their long-term financing was much larger, over RM935 million. Now, the pressure is heavily concentrated in the short term.
Yeah, it makes their success incredibly dependent on successfully rolling over that debt, probably multiple times, and hopefully at reasonable rates.
Which brings us to the counterpoint analysts often raise, the debt headroom.
Right. Analysts like HLEB point out that AXREIT's overall gearing, like debt-to-asset ratio, is actually quite low.
Exactly. And they suggest this low gearing plus the slightly more helpful interest rate environment now.
You mean the OPR cut back in July?
Yeah, the rate cut in Malaysia. They argue this gives AXREIT the capacity to actually take on more debt for good acquisitions if they're yield accretive.
Okay, but hang on. How can you talk about capacity for new debt when you've got this RM788 million refinancing cliff looming? Isn't fixing that the absolute priority?
That's the tension, isn't it? The balance sheet, on paper, could handle more debt based on asset values. The gearing ratio looks okay, but the liquidity position and the maturity profile of the existing debt are deeply strained.
So the capacity is theoretical until they actually navigate this refinancing wave successfully.
I think that's a fair way to put it. Yes, the lower OPR helps. It makes rolling over that RM788 million potentially less painful than it might have been 6 months ago. But the sheer size of it still makes it a very high-stakes operation.
Okay. One more layer on the financing side. Derivatives. They use swaps, right? Islamic profit rate swaps, IPRS.
They do, to hedge against fluctuating profit rates on their debt, basically trying to lock in fixed rates.
And how are those hedges performing? Are they helping or hurting right now?
Well, on paper, they're currently showing a loss. For the 9 months ending Sep 30, these swaps resulted in cumulative unrealized losses of RM6.075 million.
Unrealized loss, meaning it's a paper loss based on current market values, not actual cash paid out yet.
Correct. It reflects the change in the fair value of those swap contracts. It means market expectations for profit rates have moved in a way that makes the fixed rate AXREIT locked in look less favorable compared to current market rates.
So it doesn't hit distributable income directly, but it does impact their overall comprehensive income.
Exactly. It flows through other comprehensive income, not the distributable part. But it suggests their hedging isn't currently saving them money compared to market rates, and maybe their effective financing cost is a bit higher than the market might imply right now.
And what's the total value of these swaps? Is RM6 million significant?
The total fair value of the derivatives was reported at RM9.565 million. So, yeah, an unrealized loss of RM6 million against that is quite substantial in context. It's another subtle financial pressure point.
Okay, moving away from the pure financials for a moment, we have to address a major material issue, a big potential risk that's been lingering. The Youngnam litigation.
Ah, yes. The long-running legal battle. This involves a pretty huge sum of money, doesn't it?
It does. Just to recap, AXIS REIT holds what's called a judgment in default against 2 Youngnam companies, Youngnam Engineering and Youngnam Holdings, and the total claim is massive. over RM105M.
105 million. What's that for exactly? Just unpaid rent.
It's more complex than just back rent. It includes damages, compensation charges, and importantly, the rent they would have received for the entire rest of the lease term, which runs all the way out to December 2029.
Wow. So it's past dues plus future potential losses all rolled into one judgment.
Correct. Now, having a judgment in default sounds like they won, right? Case closed.
You'd think so. But the Q3 update threw a major spanner in the works regarding actually collecting that money.
Exactly. The crucial update is that liquidators have now been officially appointed for both of those Yeongnam companies, Yeongnam Engineering back in February 2024 and Yeongnam Holdings in August 2024.
Liquidators.
That means bankruptcy, essentially,
Yeah.
or severe financial distress.
Precisely. And this is where the legal win meets financial reality. The report itself states very clearly that the appointment of liquidators casts significant doubt over whether AXREIT can actually recover that RM105 million.
So they have the legal right to the money, but the companies they're claiming from might just be empty shells.
That's the significant risk now. The money might simply not be there to collect, even with the judgment.
What does that mean for AXIS REIT then? If they can't collect RM105 million they thought they were owed?
It means they likely face a major future write-off. They'll have to recognize that claim as impaired, potentially writing off a huge chunk of that RM105 million.
And a write-off that big would hit their books hard, right? Their net asset value.
Absolutely. RM105 million is substantial relative to their overall asset base. A large impairment charge would reduce their reported NAV per unit, which currently stands at RM1.6503, and would just add another layer of pressure onto that already strained liquidity situation.
So this Yeongnam issue, it's not just a side note. It's potentially as big a risk factor as that short-term debt cliff.
You could definitely argue that, yes, it's a sudden impact risk versus the ongoing pressure of the debt. Both are critical. Hashtag tag CS, financial moat scorecard, and final takeaways.
Okay, let's try and bring all these threads together. We've got this amazing operational performance on one side and these significant financial and legal risks on the other. How does this feed into our financial moat scorecard for AXIS REIT? Where do we land now looking at Q3?
Yeah, it's that duality again. Strong operations, fragile finances. Based on everything we've seen in the Q3 data and the ongoing issues, we're keeping the financial moat score for AXIS REIT at 7 out of 10.
7 out of 10, okay. And the justification? Why not higher, given the operational strength? Why not lower, given the risks?
The 710 really tries to capture that balance. It acknowledges they have a genuinely strong, high operational moat. That's the core business. But crucially, that moat is being actively undermined or counteracted by what we call anti-moat factors, which are sitting squarely on the financial side of things.
So the moat driver, the reasons it's as high as 7 is what?
It's the core business, the operational durability. They're in the right sector, high-demand industrial and logistics. They have 68 properties performing well. That 15.7% NPI jump, the positive rental reversions, that's hard proof. Their assets are top tier and well-managed. That's their competitive advantage, their moat.
Makes sense. But the anti-moat factors, the reasons it's not an 8 or 9, are purely financial.
Purely financial and structural, yes. Two main ones. First, the huge refinancing risk from that RM787.684 million in short-term debt. Their immediate future hinges on managing that successfully.
Right, the debt cliff.
And second, the major uncertainty and likely eventual loss associated with that RM105 million Yeongnam litigation claim now that liquidators are involved.
Okay, so the 710 reflects quality assets and operations being held back by significant balance sheet vulnerabilities.
Exactly. It suggests that while the physical business is strong, these financial risks are capping the potential and probably demanding a lot of management's time and attention just to maintain stability, let alone drive aggressive growth. Hashtag tag outro.
So boiling it all down, what does this actually mean for you if you're looking at AXIS REIT right now?
Well, on one hand, AXIS REIT is clearly showing remarkable strength where it counts operationally. The core industrial portfolio, it's delivering really robust growth. Their acquisition strategy seems to be working in terms of finding and integrating income-producing assets. The 9M numbers really prove they can generate strong rents and distributable income from their properties.
Yeah, the core business looks solid. However,
the Q3 data absolutely confirms those structural financial weaknesses we were worried about before. If anything, they're maybe even clearer now. The cash position is still tight. They're burning through reserves. That huge RM787 million short-term debt pile is the dominant risk factor. And the RM105 million Yeongnam claim looks increasingly like it's heading towards a significant write-off.
it really is a balancing act, isn't it? Management sounds confident, pointing to low gearing, the better rate environment.
They do. But as an investor, you have to weigh those things carefully. You need to ask yourself, what's more likely to define AXIS REIT's story over the next 12 months? Is it the steady, reliable strength and growth coming from those in-demand warehouses and logistics hubs?
Sure.
Or is it the high-wire act of successfully rolling over almost RM788M in debt, potentially at higher costs, while also figuring out how to absorb a potential RM105M hit from the Youngnam situation?
That tension really sums it up, the operational fortress versus the financial tightrope.
It does. It forces you to really weigh the certainty of that rental income against the very real uncertainties in the capital structure and legal situation.
Definitely a complex picture and one that needs constant watching.
Absolutely. Well, thanks for joining us for this deep dive.
Yeah, we hope breaking down these numbers helps you get a clearer, more nuanced view beyond just the headline figures. We'll catch you on the next one.